You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it's time to rock out once again with everyone's favorite bi-weekly options show. It is time for the option block. My name is Mark Longo from theoptionsinsider.com, as well as, of course, my little thing we like to call around here, the Options Insider Radio Network. A lot of ways for you guys to get our stuff. Of course, you can subscribe via your favorite service, your iTunes, your TuneIns, your Stitchers, and so on and so forth. You can go to the website or our mobile app, or you can join us live every Monday and Thursday, 3 p.m. Central, 4 p.m. Eastern, via the old Mixlers, MIXLR. Grab it once, set it, and forget it, and you're good to go. And, of course, however you listen, live after the fact, hit us up. Questions, comments, insights, pearls of wisdom. We do enjoy hearing from you guys. And joining me on the old program today, let's spin the wheel. Let's see who we got. Let's start off in the adjacent hamlet to Chicago, Sleepy, it may be, also known to claim many titles. Water Gardens, Pickle Capital of the World, so on and so forth. Many titles are claimed out there. It is the land known as St. Charles, Illinois, where we are joined by Uncle Mike Tussaw from St. Charles Wealth Management. What are the odds, Uncle Mike, that you would have a firm called St. Charles and you would spontaneously, randomly end up in St. Charles, Illinois?
You know what? The odds are astronomical, but things that are meant to be are things that are meant to be is the way I always look at it.
It is a universal bullseye, sir. Just the notion that those two things would come together, would coalesce on this program. Amazing. Literally a needle in a haystack, sir. And also joining us, I do believe he's got his technology issues sorted out, pun intended there, as we are joined by the Greasy Meatball, Mr. Mark Sebastian from OptionPit.com. How you doing today, sir? Where you beaming to us from?
I am, shorted, sorted, and resorted. I'm in beautiful Riverside, Illinois, one of the 10 towns that, of course, changed this great nation we call America.
America. We all like to celebrate America. I did some celebrating of America myself, the way you're supposed to do it, spending tons of money down in Disney watching 4th of July fireworks. That's the most American thing I think you could do on the 4th of July. All right, and with that, let's get the ball rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. Like the name implies, this is the portion of the show where we break down what was trading, what was going on, what was lighting it up on the old tapes. And if you haven't been paying attention, the trade war officially kicked off last Friday, and the market could give a darn about it. We've had pretty much nonstop rallying ever since the trade war was officially acknowledged and received by both us and China and some others kicking around in there. So if the thing everyone's been dreading and worrying about and selling off the market for months, when it actually happens, when it actually comes to fruition, rally ho mode. And yet again, seeing that on the screens today, most of the major indices closing up strong into the green. S&P and the tech-heavy NASDAQ up about 0.8 of a percentage point. The Dow leading the charge today up well over 1%, about 1.3%. And, of course, all that green means VIX cash taking a break off about 3/4 of a handle right about there to about 1270. Got as low, 1267 or so. Got as low about 1260 intraday, so about a 0.9 handle range or so on the day. But yeah, taking a little bit of ease. So for all of us who perhaps thought, you know, the vol was going to come in around the holiday week last week, some of us may have prognosticated that way on vol views recently. Well, we're getting it. We're just getting it a few days delayed here. And of course, all that kicking in to other products as well, like VXX coming off, nearly 2 handles today, right around 32.5 or so. So all these things, all this erosion, all this vol kind of quietly liquidating that we expected last week, we're finally getting some of it. Post-trade war, who knew? So let's start there, Mr. Meatball. First off, we're talking VXX. I saw, looks like 1,000 lot of your favorite puts went up again this morning, the Jan 10 puts. And I instantly thought of you, sir. I said, looks like Mark's gobbling up some of those. But I guess that wasn't you today? Someone else inspired?
No, it was not. It was not. I may go back for more, but that was not me today. I got to say, you know, with the old saying about remember, traditional wars, Mark, you'll remember this. What does the VIX and vol tend to do once we actually enter a traditional war?
Tends to calm down. It gets all scary, and then it just goes nice and calm.
Yeah, who knew that trade wars were exactly the same?
Yeah, you think the economic element of the trade war would make it more intense.
I guess when people realized that it really wouldn't have a big economic impact.
Uh-oh, Mr. Meatball having technical issues again. So you know what that means? That means Uncle Mike is up on the docket, sir. When technical issues abide, then we flip the script here on the old Option Block All-Star program. We're used to this kind of thing. Mr. Uncle Mike, sir, what caught your eye in today's activity, and what do you make of this continued, you know, I guess what can you call it? This continued bullishness in the face of trade war.
Trade war, schmade war. No, I think that today was a day where the financials were back, so to speak, and that financials have just been getting the tar beat out of them lately. But today they had a rally, and I think that's what led the market overall. And so I think it's still a little bit too early to tell whether or not we're either in a dead cat bounce type of a thing, or whether this is something to where it's a statement saying sell the actual news. So I think it's too early to tell at this point. But obviously for myself and all of my, I don't want to call them, I don't have crazies. What do I have, Mark? Do I have bulls? My legion of bulls out there, I guess.
You've got Skippies, Euros, devotees out there.
There you go. All of us, we go to Skippies and we buy call options all day. I mean, what more could you want? So I think that, I'm cautiously optimistic with this rally because we still are in a little bit of a channel. I'd like to see us break through the 2,800 level before I really became to what I would call the uber bullish state, so to speak. But I think that today is obviously a positive sign for the bulls out there. And with it, once again, there still needs to be some more follow through, I would say. But once again, I think that with the trade war, in terms of how that's actually factoring into things, it appears to be a sell the rumor, buy the news type of a rally.
Yeah, it's like the old, maybe the reverse, what we see of the old Apple announcements. You know, they would get everyone would bid them up and then crush them post earnings announcement. Now we're seeing the opposite here with trade war. Everyone crushes and crushes until the thing actually happens, and then we're in rally ho mode. Sounds like we got the meatball back. He recovered from falling off his stool, sir. Sir, you were in the middle of chatting about your thoughts on trade war and volatility. Anything else on your mind on that front, sir?
Yeah, just since we haven't gotten a crazy update yet, I feel like we could have, and volume's kind of light, we could have several days of this. I think everybody wants 2,800 to happen. Part of the reason why there wasn't so much pressure on the last sell-off was that everyone just expected the market to go to 2,800. Now that we're getting there again, I think we want to see that. What was interesting about today was that this is the first of these 3 big rally days where the Russell 2000 hasn't really been the leader. And, that's just this is the first one where the Dow wasn't the softest. And that's because Caterpillar and Deere got a huge lift today.
Yeah, it's funny. I was talking on Friday's Twifo show with the Russell folks, and they're loving this. They're kind of feeling like they're in the catbird seat. Of course, they're coming off their big reconstitution, which is one of the biggest stock volume days of the year usually, and it was again this year. But also just in general, Russell kind of disassociating itself a little bit. People turning to it more, buying it up more, just on the fact that it's not quite protected, but it is somewhat insulated from these macro trade war things that are going on. All these small cap names are not as tied to overseas and to international trade as the small caps are. So they're getting a lot of nice little rub over there. In fact, I was talking with someone randomly over the weekend about just this. This is how far this is getting out there, that the random retail folks are talking and digging into the notion, why is Russell so disassociated from the S&P and everything else that's going on out there? Speaking of S&P, I was chatting about this with the Rock Lobster recently, Mark, but I thought it'd be interesting to get your thought on this as well, because you were an SPX guy as well. SIBO putting out numbers that it is indeed the 35th anniversary of the SPX, which seems kind of crazy. In fact, Andrew and I were both kind of, really? 35 years? It's been that long? But it has, and it's funny to see that and kind of look back on it. I remember kind of when I first started on the floor of the SIBO back in, 97, it seemed like the SPX was kind of just coming into its heyday there. We were seeing OEX starting to wane, which was, of course, the S&P 100 used to be the big kind of pit, the big volume leader from an index perspective over there on the SIBO and the options, and everyone was quoting the 1.5 all day, and then that kind of started going away. They started expanding the SPX pit. It got bigger and bigger. More firms got out there, and it's become this juggernaut that it is today. But still, kind of weird, Mr. Meatball. Any thoughts that, or are you as surprised as we were that SPX is 35 years old?
Yeah, 38 years of SPX. What do you think about that? That's crazy. Now, what's crazy is that the S&P 500, the SPX, despite the power of the Dow, became this unstoppable force in options and futures when, prior to 30 years ago, I mean, the only index anybody knew was the Dow. Now, except for maybe the retailiest of the retail, the Dow Jones is an afterthought. That just shows you how successful I guess that makes sense. That's why Dow Jones sold their indexes to S&P. They gave up.
Yeah, Dow is an afterthought unless there's a big sell-off day and you're watching like the local news at 11 or whatever, because then they just love the big point moves of the Dow. You can't really beat that. Oh, it sold off 1,000 handles. Oh, look how crazy the Dow is. The 40 to 100 of the S&P doesn't have the same ring to it that the Dow does. So that's when we hear a lot of Dow talk. But other than that, you're right. The Dow is kind of, I was not the same thing. I was there for the day that they launched. My first day, ironically, on the floor of the SIBO was the day they launched the Dow options, and they had music and they had celebrities. I think Jordan might have been there, or Pippen, or one of those guys, and a bunch of other guys were there, and it was just a huge party. And I thought, wow, this is a great job, because this is what they do every day. Turned out that was the only day they did that. But also, B, you're right. Everyone thought that Dow options were going to be the next huge thing. And instead, SPX, and then eventually, of course, SPY, its retail iteration, those two kind of just combined to become this kind of 1-2 juggernaut. SPX for institutional, SPY for retail. And that's kind of taken up all the oxygen in the room ever since. Would you agree?
Yeah, although I'll tell you, I highly doubt it was Michael Jordan that was there. I'm going to go out on a limb and say it was maybe Dave Corzine, maybe Brad Sellers.
Orlando Woolridge.
Maybe it's Orlando Woolridge. Maybe they're going crazy and they got Scott Williams to show up. But maybe they could have gotten Scottie Pippen now after some of his financial troubles.
It might have been Pippen.
You offer Scottie Pippen a free meal and a $50 gift card to Costco, and he's in.
Might have been Pippen. It might have actually been Peyton. He was still alive back then. It was one of those P guys over there. But yeah, it was an interesting time to watch kind of the indices evolve, and here we are now, where everyone and literally their mother loves S&P, and then they all trade, apparently, given all the feedback from XIV and all that fun stuff, they all trade inverse volatility for fun. So what a world we live in now. Let's keep on checking it out and see what was going on the weirder side of that world, because it is time, listeners, for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, welcome to the Odd Block, the portion of the show where we break down, what the heck was going on out there in the rest of the world, the weird side of the world, including, like to kick things off in a name a few of you may have heard of, Tesla. I believe it's pronounced ticker symbol TSLA. Of course, I'm talking Tesla. We like to look at the weird puts that go up out there, and they continue to go up there day in, day out, and today is no exception. Tesla, yet another size upside day, outpacing the market by about 3x percentage-wise, at least, to the upside, up about 3% or nearly 10 handles on the day to about 318. I was talking to people this weekend about selling Tesla puts, too. The conversations I get up to out there floating around on the weekends. But, Tesla, a lot of people love to have that 300 level selling puts, and it's kind of threatening that again after being back up at 370 now today, putting a little distance between itself, up about 10 handles. But what we're looking at is actually on the downside, the far downside, all the way out and down to the Jan 2019 50 puts. And let's see if these bad boys were lighting it up again. Yes, they were, to the tune of 703. If you wonder how much these things are going for today, they're going for exactly $1. So you too can get 703 of these 50 puts for January of next year for $1. So there you go. Worth noting as well, the 20s and the 10s also trading up $1.60 or so, and about 116 of the 20s. 58,000 open on the 50s, 13,000 open on the 20s, which is kind of interesting. If you're saying to yourself, that's interesting, but I want to go a little bit farther out, I think it's going to go belly up, but perhaps not by this January, maybe by the January after this January. So January 2020, well, we got you covered. Looks like someone agreed with you today, because the Jan 2020 50 puts lighting it up to the tune of 2K50, actually, to be precise. Also 20,500 open on this strike. So these bad boys continue to trade it up. They're worth about $4, at 435 going out today. So if you want to get a little bit more time, it's going to cost you about $4. And if you want to go a little bit farther down, the 20 is a little bit light today, only 100 odd going up. About 12,000 open on that strike as well. This goes to show how much CDS activity continues to go up on this name and how much they're willing to pay to hedge it, because these things continue to be the dominant names here in our odd block a day, and also the dominant position out there in Tesla land. Don't take my word for it. Go look it up for yourself, and you shall see that Tesla Jan 2019 50 puts continue to dominate the market. Speaking of dominating the market, we were talking earlier about Russell and how it's kind of just dominating the index space right now, at least from a outperformance perspective. Well, if you're one of those Russell lovers, and we know they're out there, then maybe you're playing in this name as well. This is the iShares Russell 2000 Growth Index ETF. Say that 5 times fast. AKA IWO. Closing today, $212.22, up about $1 and change, or about 0.5%. It's a name that doesn't do a lot of paper. About 1,500 contracts a day. Today, doing 91,000. Worth noting, 91,000 on the calls and 91,000 on the puts and 4 on the calls. So, interesting day. Let's talk about those 4 calls. They're very interesting. Now let's go out to the puts. This actually might be our highest put to call ratio ever on the odd block. 22,781 to 1 puts over calls out here. And what we saw was kind of looks like a funky, sizable rolling of a put spread. Looks like it was the July 200-210 put spread going up 20,000 times against 25,000, of the AUG. Same strikes, 200-210 put spread. So it looks like paper coming in, buying the July put spread, doing it again 20,000 times for $1.55 and 25 cents, so $1.30 on that spread, and then coming in looks like, and perhaps a lot of mid-market executions on this bad boy here, but perhaps looks like selling the 200 puts of that leg. So that would mean, of course, buying the spread as well, which would be kind of weird, a bit of a funky thing. It looks like it's more of a roll. We'll get to that in a second. Again, 25,000 of the AUG 210, 200 put spreads going up 340 on the 210 puts, $1.25 on the 200 puts. Worth noting as well, there's some decent OI, at least on the July side. There's about 20,000 on the 200 puts and 24,000 on the 210 puts. And let's go out to AUG, where, of course, there is none, so that's why it has the feel. All the feels of a little bit of a roll. Worth noting, the July leg was opened back on June 22nd. So a few weeks ago, the stock was about $1 lower, and at least for those options, they were about $1 to $1.15 on those bad boys for the 210 puts. Let's look at the chart here. Let's see what IWO has been up to for the past year and see what our friend has been up to here as well. About a year ago, IWO was trading about $1.69 or so. So it's been on a nice rally ho mode, as you might expect, given everything that's been going out there in Russell land of late. Kind of peaked recently at about 215 or so, then kind of prompt back right around the time this spread went up, right about 621. So the day or so before this spread went up, and it kind of sold off pretty nicely, got down to about 203, so had a nice little downside run. So if someone was indeed selling this put spread in July, then maybe they did want to wait for this thing to rally back and then take it off, and then this would be decent timing on that front if that was indeed the case. A little bit of a sell-off, then rally ho again. So pretty much back to unched where it was on the underlying. But it looks like if that's the case, they're not giving up the ghost on the spread. They're keeping it alive, just moving it out to August and doing a little bit more size to boot, doing about 5,000 more contracts. Let's start here, Mr. Meatball, sir. What's your spidey sense telling you on this? Looks like a roll, a little bit more going on the second leg here. Usually that's a sign of house money, but you never know. What you think on this? You think you feeling roll on this bad boy as well?
I do the same kind of trade. So anytime I see like kind of the same trade but slightly different timing, and they did more of it, that tells me that not only were they right, but they think they're going to continue to be right, and they're pressing. So I think it was absolutely a role where the guy's like, not only am I right, I'm really right, and I'm going to press. So when I see that type of paper, I always raise an eyebrow. And if I see this guy do it again, then I would jump on board, because that tells me that this is a smart customer.
Yeah, it has all the hallmarks, like I said, of a bit of a house money roll. Usually you got some money, you did all right on the trade, you do a little bit more. Sometimes you do a ratio, maybe you do 1.5, 2x. He's not going that crazy. He's just doing an extra 5,000. But again, that could be a sign that he's sitting pretty, or it could be a sign, usually it is. Sometimes it's a sign he's like, I really got to make that back, I want to do. But usually it's a sign that they got some cash sitting in their pocket as a result of the first trade. I think it's going to work out their way again. We shall keep an eye. I'm going to mark that one down here right now as a to be watched. Whenever someone has a decent roll out here, and it worked out for them at least the first time, it's always worth watching. We'll come back in a month or so and see how our friend does on leg 2. We'll also look at the OI and see how what he was actually up to out here as we move on to our next name. I think this is a newcomer here on the odd block. This is Endo International PLC, ticker symbol ENDP. Closing today, $11.22, up about 36 cents, or about a little over 3%. That's a name that does actually decent paper, about 5,000 contracts a day. Today doing about 9x that, about 45, almost 46,000, about 26.5 to 1 calls over puts. And it looks like we got a funky closing and perhaps opening again. Vertical adjustment, maybe vertical roll, call it what you will, but it's not rolling out. It's rolling, moving around all in the same month. There's a whole bunch of verticals going up in January in this name. In particular, we saw the what looks like here. We started off with the Jan 7/2 going up 11,400 times for 420, right on the bid there. Then the Jan 10s going up 11,400 times as well for 260. Those on the offer, so it looks like paper coming in, perhaps closing out this vertical, because there is decent OI on both of these strikes. There's about 18,000 open on the 7/2, and on the 10s there's about 15,000. So more than enough paper on both or I should say OI on both to cover the paper that went up today. A total, I should mention, about 12,000 on the 7/2 and about 14,000 on the 10s went up. So decent paper on those. Maybe someone deciding to come in and closing out those 7/2, 10. That was a little bit too perhaps in the money for them, and then deciding to reestablish again 5,700 times the 11-15 vertical, doing that, because 5,700 times doing the 11s for 217 and the 15s for 75 cents. Totals on the day for those of about 6,000 total on the 11s and about 8,300 actually on the 15s. Not much OI of any to speak of on either of those strikes, so clearly opening on those. So be a little bit weird if that was the case. They had a vertical that perhaps worked out for them and then they decided to keep it in the JN, but not the craziest thing we've seen. Let's look at a chart and see if that is perhaps the case. Let's go back a year, and ENDP was trading pretty much right where it is right now, about 11.27. So pretty much unched about a year ago. Then over the course of that year, it's had some troubles. It got down to about 5 and change back in November, and it was that range again back in May. So this vertical that he put on, which I should note he put it on, he opened it back on May 30th. The stock was 645 when he opened the initial vertical, the 7.5-10. So yeah, that was a decently out of the money call spread. And guess what? Now it's pretty sizably in the money. So it looks like our friend got a little bit more. Weirdly, though, usually when you got the house money, that's the time when you spend more on the next leg. You buy more size because you're so convinced it's going to work. He did keep the party alive, but he kept it in the same month, and he did less size second time. So kind of interesting. Either way, Mark, this is a bit of a weird one here. The other one looked like it was a bit of a house money roll. This one seems like he did all right on this one. ENDP has kind of been in rally ho mode ever since, June 6th. It was trading 650 then. Ever since, it's pretty much doubled since then. So clearly they're doing all right. This is the name that, this is the pharmaceutical, go figure, generic and specialty branded pharmaceutical company. So they're known to have some upside explosions at the time. So this could be classified perhaps as a well-timed vertical. Mr. Meatball, what's your thought here on someone having a vertical? Looks like it worked out their way, then deciding to come back, close that out, come back in the same month, and do half the size again in some higher strikes in the same month.
Yeah, it seems like they're happy with what they did. See, this is more classic kind of standard paper, not smart paper, where their first theory was right, but they don't totally trust that their methodology is going to keep going, but they want to participate if it keeps going. So, when a customer rolls the same size, I'm interested. When they roll more, I'm very interested. When they roll less, that's almost the same as when they close and walk away for me.
So when they roll less, you think they don't have the courage of their convictions anymore, or they think maybe the good move has already happened? Yeah,
they think the good move's already happened, or they just want to make sure they don't completely lose if they're wrong. That kind of thing. Or they want to be able to explain to their clients that they continue to participate, but they don't really believe what they're doing, is what that says to me. So this would be, whereas the first one would be one I'd be very interested in piggybacking. This is one where I almost would never piggyback.
Perhaps throwing good money after good in this case, or bad money after good. I guarantee you they put some money aside so they can report a nice win, and then they're just making sure they participate a little bit. Maybe they have less faith in their source at this pharma company this time around, so they're only doing half the size. Either way, we'll put that one in the that's a little bit longer term out there. We'll put that in the to be watched category as well. See how this one fares as we roll on to our last name, a name you guys probably are familiar with, Amgen, ticker symbol AMGN. Closing today, 194 and change, up a little bit over $3, or about 1.7%. It's a name that does decent paper, nearly 10,000 contracts a day. Today doing 46,000 and change, about 6-to-1 calls over puts. The lion's share of that coming in this vertical that ended up doing decent size in Amgen, but started off with a lot of small chunks, which is always kind of interesting. It was the AUG, not the monthly, but expiring on August 3rd. 195, 200 vertical going up. Let's see, starting off the day 700 times for $1.50 for 233 on the 195s, $1.50 on the 200s. So 700 times, and we saw a bunch of smaller lots coming in, 487, 400, so odd, 300, 200, all the way adding those up throughout the day to the total of about 13,000 on the AUG 195s and nearly 11,000 on the AUG 200s. Worth noting, this is all opening. of this. Looks like, yeah, there's about 100 some odd contracts on each, and so all new opening paper. I'm looking and trying to find if I can see the first print on this. That's usually indicative of whether it's a newsletter trade, but these blocks are bigger than a typical newsletter. Usually a newsletter print will be, a couple of thousand to start off, and then a bunch of the lemmings coming in 25, 50, 13, 8. A bunch of weird little retail paper following after the big newsletter guy's already front run his own clients, essentially. This doesn't look like this case. This is like a small execution, big block execution broken up into a lot smaller chunks. If only you were sitting next to someone who could perhaps expound upon such things. But I digress. Let's move on here to the charts instead. Let's look here. Yeah, about a year ago, Amgen was right around 171. So about 23 handles shy of where it is today. It's had kind of a topsy-turvy year. Got up to nearly 200 back in January. Then it's kind of sold off back down to 165. So it's had quite the range, 165 to about 200. It's threatened those ranges several times over the course of the last calendar year. So it has by no means been a straight-up trajectory for Amgen. The last few months have been straight up, though. Since about May, it's been kind of on a nice upside tier, which makes this vertical perhaps look even better. So looking here, we need 195, 200. Mr. Meatball, what are your thoughts on this one as you wind up at the odd block here? Both the kind of near-term nature of it, which makes it interesting. Someone obviously thinks something's or is concerned about something popping off in the near future here in Amgen. It's right at the upper band of that near-term chart, so perhaps someone thinking we're going to retest those near-term highs, but maybe not explode through it. And then also your thoughts on kind of the funky execution. A couple hundred here, a couple hundred there, all adding up to a spread doing about 13,000 contracts.
Well, this may be some sort of correlation trader, because I don't know if you saw a chart of Biogen this week, but it went off the chains higher, like insanely high, because they might clear up their Alzheimer's drug.
So they're slinging this one against Biogen, you think?
So maybe it's something, because Amgen and Biogen tend to track each other, and they tend to be kind of working on interesting things together. Even though they don't work on the same drugs, people generally think if Biogen's doing great, that probably means the Amgen's gonna be doing great, and vice versa. So the short-dated nature, I'm gonna guess, is more related to what happened with Biogen this week than with anything that is gonna happen with Amgen. Really cool.
That could be. I'm looking at Biogen paper here today, and they had a pretty active day. They average about 5,000 contracts a day. Today, doing about 25,000. So they had pretty interesting. Look and see if any obvious correlation paper going up here. But it could be, you're right, they were leaning on something in Biogen, and whenever they got filled, they turned around and they did their pairs trade, their correlation trade here. In Amgen, they get filled here, they do 300, they get filled here, they do a couple hundred, back and forth here. I'm looking at, it looks like a vertical did go up 370, 390 in Biogen, about 1,500 times, but that wouldn't necessarily correlate to what we're looking at here. Lots of paper going up here across the board. Biogen, like I said, has been moving quite a bit last week. The 5th, it went out about a little bit shy of $300. Today, it's closing at 353.93. So, yeah, it's been quite a mover and a shaker out there. We'll keep an eye, perhaps, on this guy. Let's get three to be watched today, which is a near-term record for us here on the old odd block. We'll keep a watch on the Amgen vertical as well. Meanwhile, it's that time of the week. It's time for you guys to take the reins, questions, comments, insights, all that good stuff. It is time to open up the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, we got a bunch of listener cues to get to. Also, the questions you guys were all fired up about our question of the week last week, so maybe we'll start off paying that one off. We asked you guys last week, hey, you guys, or traders in general, generally like to fade vol going into holidays last week, kind of notwithstanding a bit of an aberrant week because we had the whole trade war thing lurking on the horizon there. We asked you, though, in spite of all that, what's your favorite vehicle when you want to wager on the dark side of volatility? You can go short-term or long-term. Leave that up to you. That's your choice. And if you didn't have your favorite there, you can hit us up. We gave you 4 choices. We gave you the old kind of standby, kind of really feet to the fire, short VIX futures if you want to go that way. You really want to get in, dive in, get your hands dirty. Or you can go a little bit more removed, long VIX puts or put spreads. We don't judge. Or even farther removed, long VXX puts or put spreads. Or you can go short to the dark side on the upside of VIX, which can be its own feet to the fire as well. Short straight up VIX calls, which we don't advocate, or call spreads. And it turned out that the winner was, with about 33% of the vote, was the long VXX puts with about, and then we got 23% short VX, so 27% saying short VIX futures. That surprised me. So almost a third of you saying you're willing to go out there and blast away at VIX futures, which is interesting, impressive. And then 23% saying short VIX calls, and people are always running, I'm so scared of futures. So shorten the VIX futures. Interesting. And last, with only 17% saying you want to pick up some long VIX puts. So not a lot of love for VIX downside, which I guess is echoed by the paper out there. Not a ton of VIX puts lighting it up. This week, we asked you, we're coming back up to it. It's hard to believe we're almost back in it again, but we're almost back in earnings season again. So let's look here and see if we could find our question of the week, which is right here. Here we go. We asked you guys, hey, trading options during earnings season. Talk about a lot on the show. It can be very challenging. Some people live for it. Others live to avoid it. Do you guys hold your options positions through earnings announcements? If you do, what is your preferred MO? Or do you prefer to trade maybe just before or after the earnings event itself, so not through the event, but just around it? Or is the whole thing just too risky, and you say you want to get the heck out of Dodge? Let's start with you, Mr. Uncle Mike. What do you think is our audience's preferred way to go? Or first off, let's start with what is your preferred way to go, if you have one? And then B, what do you think our audience's preferred way to go is, sir?
San Margano's.
Well, typically what I like to do is I wish earnings announcements didn't exist for what I do. Large movements as such are not something that are friendly to me. So unless, of course, I'm long premium. But typically, I'm not a fan of trading earnings just for earnings. Now, if I'm in a stock and I want to hedge myself, then I think there's a good variety of ways with which to do it, which would kind of give me a way with which I would want to play earnings. And I think that's just by doing a vertical in one way, shape, or form. Pick a side, and if you're bullish, buy a call spread. If you're bearish, buy a put spread. That's the way that I would play them if I were to do them. Whenever I'm hedging against an earnings announcement in some way, I'll usually buy a put spread for that purpose. I think it's a very efficient way with which to do it. And if I were to want to play both sides of it, the traditional thing that we typically talk about on the show is how the straddle perform in relation to the earnings. I don't know if I would necessarily buy a straddle, but what I would do is some type of a back spread to where if I'm expecting a large move, if I get my move, then I want to be right and make money. But if I don't get my move and it goes the other way, I'm okay maybe breaking even or getting a small credit in some way, shape, or form. So typically, I try to avoid them, but if I were to play them, that's probably going along the ways with which I would. And strangely enough, we can't fit all that into 280 characters on Twitter. We love to be more nuanced in our polls, but the methodology for Twitter is what it is. Looks like Mr. Meatball has fallen off the stool again in his pool house. We'll see if we can get him back. Meanwhile, let's look at what our audience is feeling out here. And so far, at least, again, it just went live before the show, so you got a week to vote. So you guys in the podcast can all go vote as well, not just the live folks. And so far, it's a tie in the early voting. A third saying, yes, you like to trade through the event itself, and you do it short premium, so playing close to the fire there. Another third saying, yes, but you do the opposite. You go long premium. So I guess that's what makes a market, right? Everyone has their own flavor of trading. 27% say you kind of trade around the event itself, which is, I think, if we had a way to advocate here, if we had to advocate one, probably be something along those lines, a little bit more subtle, nuanced. And then 7% saying no, too risky. I can see that too. I'm not going to, I won't judge the way you trade earnings, to each their own. Let's see here. We got a bunch of other questions to get to. What do we got here? We've got
well, this is a, let's see. Here's an interesting one, Mike. Interesting question. Came in a while ago. It's an interesting thought question. I mean, we throw these terms around a lot, and we don't really maybe stop to think of their origins all the time. But Splitsville wants to know, why is the long put / covered call a collar while you short the put and you long the call? That's just a risk reversal. Oh, I never understood that one. I think I've chatted about this before with some other people about the origins of some of these terms. When I first came to, at least on the risk reversal side of it, you never really said collar on the floor because you weren't really dealing. You didn't think of it from an underlying perspective. It was usually from your net units on a strike, and you're looking more from a skew perspective. That's kind of how you traded as a market maker. So risk reversal is always seen as how you could reverse the risk of your skew effectively. If you were short puts, long calls, you wanted to change that, you come in with a risk reversal and you could change the whole thing. So that's kind of where I kind of saw it. The collar is a name I kind of came to later. When we started doing the content, we started interacting with retail, and they started calling it a collar. And I was like, what's this collar? It's just a bearish risk reversal to me. But to each their own. Yeah, but you're right. It is weird. A collar makes, I think, a lot more sense because you're literally collaring the returns on your underlying. So if you got a long stock, collar, of course, is long stock, long put, short call. And usually it's a nice little covered call there. So you're collaring your stock to the upside. You're collaring the stock to the downside. It can't really go beyond that band. And that's kind of where the name has its genesis. So that one makes more sense to me. I think risk reversal is a little bit more obtuse. I don't know, Mr. Uncle Mike, do you even use the term risk reversal that much? You're mostly probably, if you're using these, you're probably more on the collar end anyway, right?
No, I use the risk reversal. I think that with what I'll do, there are some times with which I'm short puts and long calls for purpose of the risk reversal, and there's one that I'm doing right now from a longer term standpoint. I'm in a January of 2019. I'll do it. It's a leap for my longer term clients. January 250 short put, long 290 call on SPY, and it's one where the market's been fairly volatile this year, but I haven't had to make an adjustment to it yet. And going into this year, it was, I think I adjusted it from last year. And I got in when SPY was at roughly 275. And what I liked about it is that I had a lot more room to the downside than I did distance from the profit zone, so to speak, to the upside. And it wasn't just because of the dividends on the SPY. There was greater than what the dividends would have been. So I really like the trade. And I think it's, from a synthetic standpoint, a risk reversal is similar to a knockout collar, but with a little bit of upside to it.
Yeah, I think there's a lot of ways you can. Let's make some fun. I've always said many times the bullish risk reversal. If I have to have a go-to type strategy, that's one of the ones I like. It's just a fun one. It's a great one for people out there who like equity exposure, maybe don't want to trade the equities. A bullish risk reversal is a good way to go about getting decent amount of delta exposure, or whatever you're looking for in the underlying, without all the outlay that goes with it. So always a fun one there. I think we have tracked down the meatball there. Mr. Meatball, 2 questions for you. First off, if you want to expand upon collars versus risk reversals, why we call one versus one, have at it. And then secondly, our question of the week this week is we're asking people, earnings season coming back up. So we like to get their pulse on how they like to trade earnings. Do they actually trade through the event itself? If they do, are they short premium, are they long premium, or are they more they like to trade around the event, or they just stay away from this? Maybe we'll start with the earnings ones first. What are your thoughts, and what do you think our audience is picking? Then if you have anything you want to expand upon with the whole collar versus risk reversal debate, have at it, sir.
We all know my thoughts. I'm never an earnings guy. I avoid it altogether. But our clients, or the listeners here, are all, I feel like our group is an aggressive sell the earnings premium group. So I'm going to say that that's part of it. And then the other side was what? VIX question?
No, the guy was asking, why do we call a collar, but the other side of it is just a risk reversal? He wanted to know that.
They actually, on the floor, we called the one side the risk reversal, the other side the risk conversion, not a collar and a risk reversal. And the reason why we called them that was, one, reverse your risk, and one, just converted your risk into something that was more palpable. So, yeah, there's the risk conversion and the risk reversal. similar to a reversal and a conversion. So all it had to do with whether you're buying call and selling put, or buying put and selling call. So the risk reversal is the same trade, just different strikes as an actual reversal, and the risk conversion is the same trade, just different strikes as your standard conversion, and that was it. So that's actually where risk reversal comes from. But if you think about it, it's using options to reverse risk versus using options to convert risk.
Yeah, it's funny. I was just saying before you were back on that, I'd never really even encountered the term collar until we started doing the content side of it, and we started engaging with retail, and they all started hitting us up about collars. And I was like, oh, you mean the bearish risk reversal? Okay, all right, I see what you mean. But yeah, it's not a term we ever even used. It just wasn't. It wasn't in the market maker lexicon back in the day. All right, let's see. We got time for some more here. Alto wants to know. He's got like a threefer. Let's see if we can get them all. He says, which do you think has a better chance of happening? No more earnings calls or after hours options trading? And he says, and which do you think would be more impactful for options traders? Oh, and do we have a preference? It's actually kind of like a four-for, I guess you could think of it. So yeah, he's talking about that. I think that debate. I think he mentioned a month or two ago. I think it was Buffett and a few others coming out and making a big push to get rid of earnings season, effectively get rid of these kind of set regular earnings calls, because they're kind of this kind of binary risk event for the marketplace. And I think they kind of create Wall Street's too focused on what have you done for me lately, very short-term focused. I think, go figure, Buffett wants things to be longer term. That's kind of his focus. I think I could kind of share some of that mentality. I think Wall Street is very much what have you done for me lately, sometimes to its detriment. But then again, for us here, the active options traders, we like that. We like having these moments that generate volatility, that generate underlying movement, that generate opportunities for trading. So if they went away, yeah, it's kind of a bit of a double-edged sword. Maybe in the longer-term health for the economy, it would be a good thing, but in the near-term benefit of options traders, it would be perhaps a very detrimental thing. So what has a better chance of happening? Let's go with the first one first. No more earnings calls, or I'm going to say after-hours options trading, because the earnings call thing is so ingrained. That's probably not going to happen. But the after-hours options thing at least has a small probability of happening, maybe sub 10% probably, but we'll probably see some sort of pilot eventually in the next couple of years. So one of the smaller exchanges, maybe Box or someone else, who's trying to get out there and really mix it up and gain some market share. And they don't have a lot to lose, so someone's going to try it eventually. And so I think we have a better chance for that. I think for options traders, I'm going to have to say, probably the after hours would be more impactful. If you have a preference, I would definitely like to see that before I like to see earnings calls go away. Mr. Uncle Mike, a lot of questions here. We'll take them in order. Which one do you think is going to happen first? No more earnings calls or after hours options tradings? Which would be more impactful for options traders? And do you have a preference?
All right, so I think that after-hours option trading has a better chance of happening, just because, like you said, Mark, earnings calls are such a staple that I really don't see that going away. And there is a lot of talk about after-hours option trading coming to fruition. I don't know if it's really going to be really that big of a thing, but I do think that there will be some exchanges and some brokers that will give it a shot at some point. When, I don't know, but I do think it will happen. Whether it's going to be last or not, that's debatable, but we've talked about this on the show a lot. I don't think it's going to be a very plausible thing, just because of the fact that if SPY options have bid-ask spreads a mile wide after an employment report, after a Fed announcement, then that makes me think that after-hours option trades would be bid-ask spreads would be a mile wide after an earnings announcement. In terms of which I think would be more impactful on option traders, I actually think getting rid of earnings would be more of an impact, because it would take away a lot of the volume of option trading, whereas after-hours option trading, I think that the bid-ask spreads would be wide enough to where I don't think a lot of people would do it. I think there'd be some institutions that would do it. There'd be some retail that would do it, but I don't think it would be a big thing. But I think that taking away the earnings announcements would be a much bigger impact on option traders. In terms of which one I would want, I would love it if we could have like maybe a yearly earnings call or something like that. That would make my day. That would make me excited. But unfortunately, there's a lot of things that I want that I don't get. So that's where I stand on all.
Yeah, no, Mike, I agree with you. I think that getting rid of the calls would be a real negative to the equity market, which is, the only thing, if you look at options, index volume growing, VIX volume growing, ETF volume generally flat or growing, but equity volume dying. If you want to just take the equity vol out to the back of the shed and old yeller it, then do that earnings conference call play. Right. Yeah. Which is why Which is why trade around earnings. Don't like I said, I don't like trading through earnings. I love trading all the way to the last minute before earnings, and then trading immediately after earnings. So in terms of additive, I think that there would be, the issue we'd have to deal with would be allowing retail customers access to that options market, because I can tell you retail customers would want to take their money. They would most benefit from being able to take their money after hours relative to market makers and other people like that. Market makers would just trade the stock. So there'd be no change there. But it would be the people it would benefit would be the small guy. So now, if you're asking, will any of these happen? The answer is no, because part one is really bad for the big guy, so that'll never happen. And part two is really good for the small guy, so guess what? That'll never happen either. So we can talk about it all we want. Neither of these will ever happen. There's just not the voice to make it happen.
Yeah, very low probability of both. I think options after hours have to be slightly higher, but it's still you're talking a 5% probability versus a 0.01% probability of that happening. Either way, interesting stuff. I'm sure this debate will not go away because Buffett and others will keep popping up and pushing it, so it won't be the last time we discuss it here. Meanwhile, though, we got to keep on rolling into our final segment. It is time to go around the block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. And I know a lot of you out there are kind of sick to death of trade war this and macro that, which is why the Russell's doing so well of late. For those of you out there, I got some happy words for you. Earnings season's coming back. We're getting back into it again pretty soon, so not so much for the bulk of this week. You got some names. You got PepsiCo. You got Delta Airlines coming up. Pepsi on Tuesday, Delta on Thursday. Friday is when it kind of starts kicking off a little bit again. You got JPMorganChase. You got Citi, Wells Fargo, PNC. A lot of the financials kicking off on Friday. So for all of you kind of just want to just focus on something micro, something limited, just a very binary type of event, we got you covered. Earnings season is back. You can kind of hopefully take maybe a little bit of a break from the will they, won't they, endless crazy dance that is trade war and everything else macro going on right now. Let's go back around the horn and see what everybody else is focusing on. I'll start with you, Mr. Uncle Mike. What is top of mind at St. Charles Wealth Management this week, sir?
Well, I want to see if we can continue from today's rally. Financials did rally. I want to see if this is a dead cat bounce type of thing, or I want to see if we can continue from it. So continuation is the key. We had the employment report last week, so this could have an impact on that. And then our president is speaking tonight to see who our new Supreme Court justice is. So that is what I'm going to have my eye on.
There you go. And Mr. Meatball, same question for you, sir. What is top of mind over there in the land of the pit this week?
Well, it was my 40th birthday last week, and we offered the gold course at 40% off for me turning 40. That's only $900. And I had turned off that deal, but I had not gotten to talk about the deal since I wasn't on the show. So, and I had to leave early last week, blah, blah, blah. So what I'm going to do is you're going to have to be an Option Block listener. And if you go on the Option Pit site and you write in Mark loves Mark. So that's Mark Longo loves Mark Sebastian. Mark loves Mark.
So you're telling our listeners to lie to get deals. That's what you're telling them.
I'm gonna extend that 40% off through the end of the week, but I'm not gonna publish it. I'm not gonna print it. I'm not gonna do anything. No caps, no nothing, and it'll take that 40% off. So you get to do the gold course for $900, and I'm gonna give you a free month of Andrew's volatility newsletter. So it's the deal of the year because I am officially old.
Welcome to the elderly club. So our listeners, you have to go lie. Listen, you have to go lie to optionpit.com and put in Mark loves Mark. Remember, Mark with a K. We're none of these Mark with a C's floating around here. We don't talk to those kind of people. Yeah, but that would be apparently what he's focusing on for the rest of the week as well, is his 40th birthday and his deals. Head on over there, optionpit.com. Enter that code if you are indeed so intrigued. That music, of course, means that we are done. Listeners, I want to thank you for joining us yet again. Let's go back around the horn one last time. You already know what you can do at Option Pit. You head on over there, type in Mark loves Mark, and you'll get 40% deals because Mark is now an aged fellow. Uncle Mike, sir, what are you doing to celebrate the encroaching of death?
Well, I'm almost 41, so I'm kind of over it. I'm cool with being old. But nonetheless, if you want to work with another old guy, if you want him to manage your money, such as myself, feel free to contact me at 312-212-3531 or check out my website at stcharleswealth.com. We will have some events coming up, and I will continue to keep the audience posted.
You guys just decrepitly old. Me, I'm like 26, so I can't speak to what you aged fellows are all up to. If you want to hear more about what these aged, decrepit folks are up to, stcharleswealth.com or optionpit.com to learn more. And on behalf of the Meatball and Uncle Mike, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, all the fun stuff that you guys do. Stay tuned to the network. A lot of good stuff hitting it this week. There still is a couple of things coming out from OIC. You had to get approval for some of those panels to go live, so there might be a couple of panels still to come your way this week from OIC land. Stay tuned for those. Maybe even a few interviews still cooking around in there, so stay tuned for those. Also have all the great sessions coming your way from the Swan CIO panel session, so that's coming your way as well. Again, all free, because we like you guys. So stay tuned to that. And meanwhile, we'll see you back here on Thursday for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.